Welcome back to another episode of Investing Explained. Here's today's question.
If we're talking about value investing and we're talking about 10Ks, there's a few areas you want to look at. One, you want to first figure out what the heck the price is, which isn't in the 10K. But after you do that, we're big fans of operating income or kind of, measures of profitability that are a little bit further up the income statement, not net income, because it can be gamed a lot. Another thing you want to focus on, there's actually a really cool paper about this. Again, I'm a quant guy, so I'll give you a quant perspective. But what some researchers did is they actually look at 10Ks and they machine read them, because for 99% of them are templated. But what they did is they said, hey, all these lawyers, they make you write this templated language. But what happens when the template language changes? And specifically, is there certain sections of the 10K where when the language changes, it really matters the future performance? And one of those is actually in risk factors. If you just look at the template language in risk factor section and you do it year over year or quarter over quarter, however you want to do it, and again, I recommend doing a computer, but if you don't have a computer to do it, you can do it by hand. Whenever you start seeing additional risk factors listed in there, i.e. the lawyers are like, guys, we need to kind of cover our ass here. And we don't want to talk about this publicly, but this is our disclosure document, so we need to legally disclose this here. But, because obviously they're not going to make this front and center on the conference calls. But I would focus on that risk factor section and don't just read it absolutely, read it relatively to what they've said in the past. And if you all of a sudden see a whole addition of risk factors,
that's like a momentum way of seeing the relative change in a 10.
Yeah. It's crazy, man. These guys use a computer to literally like machine read, and they look for these changes. And risk factors is where a lot of these CEOs like go bury information that's super relevant to market expectations, but because obviously they're CEOs, they don't want to like talk about these things or emphasize them. So a lot of times it kind of goes to the wayside, but it's highly predictive of basically poor performance.
Because that is so true. That they'd have the lawyers just adding all sorts of, that is so smart. And I've never heard that before. I really like that comment. That was amazing.
I'll give you one more that's also just kind of varsity level fundamental, but there's another thing you do is like customer supplier relationships. There's an old trading strategy where, basically in those 10Ks, you got to disclose over 10% revenue partners. And obviously, like, let's say Stig, and there's a class examples like golf clubs. So Stig is Callaway Golf, and I'm like a head supplier for golf clubs. If all of a sudden you want to follow Callaway Golf, if you come out and Stig says, dude, my sales are horrific, and you're analyzing me, the company that's making the golf heads, because I'm going to report in like a month or so, and I know that Stig is 80% of my revenue, I might want to consider the fact that Stig just said his sales are abysmal, because that is going to affect me a lot. And what you do is you get these customer supplier price reaction lags where you have information in the marketplace on another company that is economically linked to the company you're investigating, but you may get blindsided if you're just looking at the 10K in isolation, but not considering like the ecosystem. So that's another trick that a lot of like kind of varsity fundamental guys like to do. They kind of like to understand the ecosystem of what other guys are releasing.
Yeah, and just something to add to this, because Brian, I really think this is a great question, and you're starting with the 10Ks because most investors, like even with years of experience, never go that far, so that's really good. One thing to say about this is that reading 10K is really an art. Like you need to read quite a few really to get a grasp on this. I remember one of the first times I was reading this risk section, and I was like, I need to go through and read all the different types of risk, and it just seemed so generic. And guess what? Like a lot of the risks that you do read about, they're extremely generic. It's something like, oh, if we can't keep up with customer preferences, it's a problem for us. And I mean, try to see if you can find a business in the world that doesn't need to keep up with customer preferences. I mean, a lot of this is completely useless. And I think in general, you need to think about that whenever you're reading not only the risk section, but basically all the sections in the 10K. And the same goes for the management discussion. How sincere is it? Is it completely generic? Did they have someone from the PR department basically write that out? Or are we talking about mistakes they're actually making? Are we talking about the key drivers of the industry, where they are in the cycle? I mean, that's the things you should be looking for, because the requirements for 10K, in many ways, they're really strict because all of this is regulated. But in a way, it's also very easy to get away with a lot of generic, useless talk. So if you can diagnose if it's sincere, in other better words, this is a trickle-down effect you see from the management and the rest of the organization. I know that this is really the art part that I'm talking about, because how do we determine that? But if you get the impression that they're trying to hide something from you, relating back to what Wes said before, they just suddenly got 50 new risk factors, then you probably should run away as fast as you can.
Well, I've got a question for Wes, because he was talking about this a little bit in the beginning of your response, Wes, about the operational income. So are you really big on really kind of going to the cash flow statement and looking at the operational income and then, subtracting your CapEx to come up with your free cash flow? Is that what you're really seeing as the real earnings here?
Well, yeah, free cash flow is a little bit difficult because CapEx is all over the place. What I was suggesting is just move up the income statement. So at the top, you got the revenue, and then, after your COGS, you got like your gross profitability, rip off some SG&A, you're starting to get to like your EBITDA kind of, and then pull off some depreciation, amortization, get the EBIT. Just all those are good. I mean, honestly, if I was just starting off value investing, whether I was a professional or not, I mean, because this is what we do, we focus on operating income, which is essentially, EBIT. And then we look at total enterprise value, which is essentially like a price. And we just buy the cheapest ones.
Preston and I recently did an interview with Bill Miller. He's basically saying the same thing. He said that EBIT divided by enterprise value, that's really the indicator that you would go for. But Wes, I'm just going to throw it over back to you because I see you have another point here.
What does Warren Buffett do? I think he reads market psychology. And whenever he sees a firm, well, we already know what he does. Like Fresini and those guys wrote a whole paper about it. It's called Buffett's Alpha. And we know quantitatively what he does. He buys cheap, he buys quality, and he buys what they call low beta. Let's just punt that. Like systematically, effectively what Buffett does in his computer brain that none of us actually have, but he does. He's just buying cheap stocks that are high quality. Key is cheap and the key is quality. And all I think he does, he sits back and waits. Oh, IBM. Yeah, they're getting their butt kicked by Google, and yeah, they're not going to become like Google, but we don't need to become Google. They're a great firm, and we just need them to do better than expected at the current price. And so all the positions he starts taking on, I think he just sits back and waits for the psychology to turn. He's earning his chops by focusing on market psychology, buying when everyone else thinks it's a stupid idea, and then just holding no matter what, even though he may look like an idiot in the short run.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.